Welcome in to another daily editorial here on the KE Report. This daily editorial, I have Jordan Royburn on the line with me. He is the founder and editor of the Daily Gold, also a weekly contributor to our site to update us in terms of what he sees, usually on the technical side for the precious metals. But today we're going to talk fundamentals and technicals. Jordan recently sent me a link to an article that he posted that I will include that link below this interview. And the article is entitled, Gold is Weak in Real Terms. Jordan, let's first start off about talking about the fundamental reasons why you think gold is weak. Kick us off. What are some of the key fundamentals you're looking at?
Well, thanks for having me on, Corey. The problem with gold's fundamentals are, and in my view, they're driven by real interest rates, specifically declining real interest rates or negative real interest rates. That's what really drives gold. And, we're looking at, you can look at the real Fed funds rate, or you can look at short-term bond yields, like the 5-year yield is something I look at to keep it simple. And the problem for gold right now, and also in the last couple months, what's been happening is the rate of inflation has been coming down. Meanwhile, in the last couple weeks, we've seen a bounce in bond yield, short-term bond yield. So that's very negative for gold's fundamentals. In other words, you have inflation, the rate of inflation has peaked and now it's turning down. So we're not, what some people say, oh, well, inflation is much higher than the Fed says, et cetera, et cetera. But what really matters is the direction. Where are these things trending? And the trend in inflation in recent months is peaked and is going down. So, and I think that's going to continue. And then bond yields, while I don't think interest rates and bond yields are going to shoot that much higher for that much longer, we did reach a point in the bond market where bonds became extremely overbought. Right now, most of the money is positioned for lower bond yields. And I remember I mentioned at one point, 2, 3, maybe 4 weeks ago in an interview that at one point they had only priced in like a 40% chance of one more hike for the rest of the year. So the Fed, even though they've been dovish, if you go back to before we had this little bounce in bond yields, the market itself had already priced in really, really dovish policy. So there wasn't that much more room where we could move higher in precious metals based on dovish policy. And so now we're seeing the reverse, where we're starting to see a little revival in the reflation trade. Bond yields have had a good bounce. And now the market, I saw a thing a couple of days ago where it was a 60% chance of one more hike later in the year. And we did get a strong ISM report on Monday, which kind of triggered that breakdown in gold. Again, if you put it all together, inflation's peaked, it's coming down, and bond yields are having a bounce here. I think that bounce in bond yields will probably continue in the near term. And if you put that all together, that's going to result in real interest rates continuing to rise in the months ahead. And that's very negative for precious metals. Depending on what you look at, real interest rates have already had a pretty good rise since February. So, they've already had close to a 1% rise. So we're not just talking about a little blip here. This is something that has been happening in recent months, and I think is likely to continue for the balance of the year.
So, Jordan, in terms of fundamental outlooks, I also think you need to include central banks in that outlook. And what we're hearing from the Fed, which was a bit of a change last time that the Fed raised rates in the last Janet Yellen press conference after the Fed meeting, was that their assessment of inflation for this year was wrong. They thought inflation would continue to pick up, and something like you were alluding to there is that inflation has pulled back, but yet we're still seeing the Fed raise rates, and they admitted about 6 months ago that they were okay with being behind the curve in terms of inflation getting out of hand to the upside. But now, after admitting that inflation is disappointing and they were wrong and they lowered their inflation expectations, they then said that they were okay with being ahead of the curve and continuing to raise. This, to me, and it sounds like even to you, would be a very negative sign for gold moving through the rest of at least this year.
Yeah, that's a great point. It would be. And the Fed is normally behind the curve. They've been behind the curve almost every cycle, with the one counter example being that one with Paul Volcker in the early 80s. But no, you're absolutely right. And they can raise rates here, even with inflation, the rate of inflation coming back, because they have an opportunity to do so. and they want to obviously get more bullets in the gun for when the next recession comes around and they can cut rates. So it's a very negative fundamental situation for precious metals. I mean, we would need to see, assuming the current trends continue, we would need to see interest rates really plunge, like plunge faster than inflation. And if the economy hits a recession at some point in the next year or 18 months, that will happen. I mean, that's what we need to see to really get precious metals going. In other words, we need to see the Fed stop hiking. We need to see the Fed pause and then go to a cut. And if you look at this Fed cycle, is kind of similar to the one from 99 to 2001. And it's interesting because we know that commodities and gold kind of did a double bottom during that time. And what happened is the Fed, they weren't hiking rates there in 1998. They kind of paused for a while, and then they started hiking, which everybody knew they were going to do. And hard assets had a big bounce there initially, but then they weren't able to make new highs when the Fed did a couple more hikes. And it was only after the Fed went to a pause and went from a pause to a cut that triggered the major bottom in gold. And then, commodities months later followed. So we're not going to see bullish fundamentals for precious metals until the Fed moves from a pause and then a cut. And I think there's a good chance that could happen at some point next year. But we're just here and now, the fundamentals, they're not bullish for precious metals.
All right, let's switch it over to some of the technical factors and a couple charts that you laid out in your post, which I will post the link to, is the gold versus foreign currencies basket, which is starting to break down, still not anywhere near some of the lows that we saw back in, 2014, but it is starting to break down, and stocks versus gold, in the sense that the S&P compared to the gold price is, again, tapping on all-time highs and could very well break out. This, from a technical standpoint, you have to say across the board, gold is not doing that well.
Starting with gold against foreign currencies, we're just looking at the U.S. dollar index basket, or really the inverse of it. So we're looking at a basket that's mostly the euro, and we could also say mostly the euro and the yen, but there's some other currencies that have a small weighting in there, but it's obviously very euro heavy. And if you look at that chart has kind of broken down from a mini head and shoulders top, which it's made for most of this year. And so it's closed yesterday, or the last day, it closed at basically its lowest point, I think, in the last 6 months, maybe a little bit longer. I mean, it's an ugly looking chart. And it also, in recent days, has lost the 400-day moving average, which it's been above basically since January 2016. And so looking at that chart, I mean, that chart in no way or form bullish. And so that tells you that recently, in the last couple months, this chart has actually sold off quite a bit. And so that tells you that gold has been performing better in dollar terms, and gold has even sold off recently in dollar terms. That just tells you how weak gold has been in real terms. And then looking at the other side is gold against the stock market. If we flip that around and just call it stocks against gold, that ratio has been consolidating since 2015. It's on the cusp of a major breakout. I don't know if it's going to break out next week or next month or after that. But at some point, that is much more likely than not going to break out in favor of stocks. And even though, I mean, the stock market has we have seen a little bit of selling and weakness there, but gold hasn't been able to do anything. I mean, there was a point last week where the stock market had corrected for a couple days and the dollar was down, yet gold was still down at the same time. So that just tells you how weak gold is in real terms. It has been holding up in the last couple months. The only reason has been the weak dollar. And remember, if you look at the rest of the precious metals sector, Corey, the miners peaked in February, and silver, I believe, peaked in April. But if not for one day there, it made a false new high there for one day. And if not for that, it would have peaked at the end of February. So the rest of the sector has been very weak since February. And since that point, the strength that we've seen in this sector has just been driven by dollar weakness, basically. Now, I don't know if if it's already bottomed. I mean, maybe it goes lower by another point and then it rallies. But I think at some point the dollar is going to rebound. I don't think it's broken or in a new bear market, as a lot of people are saying. But if we continue to see a bounce in bond yields and a rebound in the dollar, I mean, that's going to be very bearish for gold and precious metals, and we'll see a lot more selling there.
Well, one thing that I'm watching very closely for the U.S. dollar is this continued money that is flowing out of U.S. equity ETFs and into European ETFs and emerging markets. This continues to pick up steam. I don't think it's a sustainable trend, but it has been going on now for a number of months. As a final comment here, Jordan, take us through some levels that you are watching for gold in terms of where it might stop on this downward motion.
Well, I think gold has almost completely broken. I mean, not quite yet, but the levels, I mean, I was talking about 1230 to 1240 as a key level. We broke that. The next strong support is really not until the monthly support around 1140 to 1150. So that's the next level I see as far as where gold could bounce for a couple weeks, at least sustain a bounce for more than a week or so. I mean, we probably will get bounces at some point. I mean, looking at the chart, I mean, there is some support in the low 1200. So we could, maybe we'll bounce for a week after we hit 1200. And with respect to the miners, GDXJ had a little uptrend, and that's broken that little uptrend. So that looks bearish to me. And just finally with GDX, we know it's been trading in a descending triangle. The peak was 25.5 and the low is around 21. And right now GDX is trading at 21.54. So if GDX breaks below 21, the downside target that's triggered upon that breakdown is 1650. So, I mean, there is still plenty of time for people to really get defensive, get into cash, maybe buy a hedge if you need it. But, I mean, the risk reward here, Corey, I have a very strong opinion about that. The risk reward is very skewed in favor of the downside right now. And precious metals bulls, they need to be really careful here and get defensive. I mean, the way this looks, that the odds are favoring some major weakness coming in the next couple months.
All right, there you have it from Jordan Royburn. Always enjoyable chatting with you, Jordan, and I do share, some of your negative outlook for the precious metals, but right now I'm looking just a couple months out and want to reassess more near the tail end of summer. But no doubt right now, over summer, precious metals are looking quite weak. Jordan, thanks for your time.